If you opened your trading terminal this morning, March 19, 2026, you likely saw a sea of red. To the average retail investor, the headlines look catastrophic. Gold plummets from record highs, or silver corrects as dollar strength returns. After months of watching gold breach $5,000 and silver flirt with $90, seeing prices at $4,714 and $71.50 respectively, feels like a punch to the gut for those who bought at the peak. But I've spent the last 48 hours in constant communication with my head of research, a strategist I call Silas, who spent 2 decades navigating the bond desks of the world's largest central banks. Our conclusion is unanimous. This is not a bear market. This is a structural liquidity vacuum. What we are witnessing today is the margin call on the world. As the interest payments on the U.S. national debt officially clipped the $1.3 trillion annual mark this week, the global financial system experienced a seizure. When the cost of servicing past debt exceeds the cost of protecting the future, the defense budget, the pipes of the financial system begin to clog. The big institutional players aren't selling gold because they've lost faith in it. They are selling gold because it's the only asset they have left with deep liquidity to cover their massive losses in the collapsing AI tech bubble and the commercial real estate defaults that are currently sweeping through regional banks. The Gromen Thesis: Fiscal Dominance and the End of the Fed. To understand why gold is at $4,714 and not $6,000 today, we have to revisit the core thesis of fiscal dominance, popularized by strategists like the one we've been studying in recent high-level briefings. Let's call him the architect. The architect's premise is simple. The Federal Reserve is no longer the most powerful entity in the room. The U.S. Treasury is. We have entered a regime where interest rates are no longer a tool to fight inflation. They are a weapon that, if used too aggressively, destroys the government's own solvency. Every time the Fed keeps rates high to fight the inflation caused by $118 oil, it adds billions to the government's interest bill. In 2024, we worried about $34 trillion in debt. Today, in mid-March 2026, as we stare down $38.5 trillion, the market has realized that this debt cannot be repaid in units of equal purchasing power. It must be liquidated. The current correction in gold is a temporary anomaly where the dollar is being squeezed higher because everyone needs dollars to pay back dollar-denominated debts. This is the dollar milkshake in its final, most violent phase. But once the debt is cleared or the Fed is forced to pivot to save the Treasury, the dollar's value will evaporate, and gold will reprice towards $6,000 and beyond in a matter of days. The deferred asset scam. The Fed's hidden bankruptcy. Let's look under the hood of the Federal Reserve's balance sheet as of March 2026. The numbers are staggering. The Fed's operating loss has ballooned to approximately $302 billion. In any other sector of the economy, this is defined as terminal bankruptcy. But the central bank has employed a specialized accounting gimmick known as the deferred asset. Think of this as an IOU to themselves. They tell the Treasury, "We've lost $302 billion, but we'll count it as an asset because we hope to offset these losses against the profits we might make in the 2030s. This is a fantasy. Silas and I analyzed the flow data, and there are no profits on the horizon. With oil prices stabilized at $118.55 per barrel due to the persistent friction in the Strait of Hormuz, inflation is no longer a transitory spike. It is the baseline. The Fed is currently caught in a lethal pincer movement. If they lower interest rates to prevent the regional banking system from collapsing under the weight of commercial real estate defaults, inflation will spiral into the double digits. If they keep rates high to protect the dollar's international standing, they bankrupt the very government they are sworn to fund. They have chosen the latter for now, creating the very liquidity vacuum that is temporarily suppressing gold prices. This is the eye of the storm. The energy delta, $118. Oil as the global tax. The most important metric in my minor math segments isn't just the price of gold, it's the energy delta. Geopolitics in March 2026 has become the ultimate accelerant. The maritime conflict involving Iran is no longer a localized issue. It has fundamentally repriced the cost of doing business on this planet. While the United States remains a massive energy producer, the global supply chain is suffering from what I call the Hormuz premium. Because energy is still largely settled in US dollars, every foreign nation is now paying a double tax. They pay for the high cost of the crude itself, $118 plus, and then they pay the premium of having to acquire expensive dollars with their rapidly weakening local currencies, the yen, the euro, and the lira. This is why the DXY, dollar index, looks strong today, even as gold drops to $4,714. It's the strength of a vacuum, a desperate scramble for the currency needed to keep the lights on. But history teaches us that when energy prices stay this high relative to gold, gold eventually catches up and overshoots. Gold at $4,714 is currently cheap relative to the BTU energy value of oil. The correction we are seeing is a gift for those who understand that atoms, energy, always win over bits, digital currency. Fee. Minor math, the great disconnect of 2026. Now, let's pivot to the opportunity. If you've been following my minor math segments, you know that the current setup is a once-in-a-century anomaly. As I record this, gold is at $4,714. While this is a dip from $5,000, it is still more than double the price of gold in early 2024. However, the great disconnect persists. While gold has doubled, the major mining companies, the producers who actually dig the metal out of the ground, are trading at valuations that suggest gold is still stuck at $2,200. Let's look at a producer we'll call Equinox Peak Resources. Their all-in sustaining cost, AISC, has risen due to $118 oil, sitting at roughly $2,150 per ounce. At $2,400 gold, they made a respectable $250 profit. At today's corrected price of $4,714 gold, their profit margin is $2,564 per ounce. This is a 1,025% increase in free cash flow compared to 2024. Yet their stock price has only moved up 40%. Why? Because the institutional big money is still trapped in overvalued AI tech stocks and legacy bond portfolios. They are liquidity constrained. When these mining companies start reporting their Q1 2026 earnings next month, the wall of capital that will hit this sector will be unlike anything we've seen since the 1970s. The paper shorts are currently trying to drive the price down to $4,500 to cover their positions before the earnings explosion. I am not letting them have my shares. Silver, the industrial oxygen, and the $71.50 breakout. Silver is the wild card of the 2026 collapse. While gold serves as the sovereign shield, silver has become the industrial oxygen of the AI and green energy infrastructure. Every high-density H200 chip cluster and every next-generation solar array requires physical silver for its unique conductivity. As of this morning, silver has corrected to $71.50. To the short-sighted, this is a breakdown. To the analyst, this is a retest of structural support. The silver-to-gold ratio, which historically sat at 80-1, is currently around 66-1. This is happening because we are in the fifth consecutive year of a massive physical deficit. We are short nearly 340 million ounces globally. If you are holding paper silver through ETFs, you're holding a claim on a metal that simply isn't there. My researcher Silas has seen internal vault data from London and Zurich. The physical bars are being drained by industrial users in the AI sector who are bypassing the exchanges and buying directly from refiners. When the debt spiral forces the final monetary reset, silver will not just be expensive, it will be unavailable at any price in the retail market. Buying at $71.50 today will look like buying Manhattan real estate in the 1940s. The geopolitical accelerant, bilateral trade, and the death of the petrodollar. We cannot ignore the shift in global trade patterns. In March 2026, the petrodollar system is effectively dead. Saudi Arabia, the UAE, and the BRICS Plus nations are now settling energy trades in local currencies, or, increasingly, in gold-backed digital units. The architect, Gromen, argued that the U.S. would eventually have to choose between its global hegemony, the dollar, and its domestic stability. By keeping interest rates high, the Fed is choosing the dollar, but in doing so, it is starving the rest of the world of liquidity. This is forcing nations to build a parallel system. This parallel system uses gold as the ultimate neutral reserve asset. When you see gold dip to $4,714, you are seeing the old system trying to price a new system asset. It doesn't work. The physical demand from central banks in the East is providing a hard floor at $4,500. Every time the paper markets try to push gold lower, the physical buyers in Shanghai and Mumbai step in and sweep the floor. This is why the dip is being bought so aggressively. The counterparty risk. Why physical integrity is the only rule. In my portfolio, I only value physical integrity. The 2026 debt spiral has proven that if you need a bank's permission to access your wealth, it isn't your wealth. It's their liability. We saw this in the regional bank Holiday last month. When the liquidity vacuum hit, the banks simply shut their apps. Those who held physical gold and silver in their direct possession or in non-bank high-security vaults in neutral jurisdictions like Singapore or Switzerland were the only ones who remained liquid. The paper gold market is currently 100 times larger than the physical gold market. This means, for every 100 people who think they own an ounce of gold via an ETF or a bank contract, only one person can actually take delivery. The current price of $4,714 is the paper price. The physical price, what you actually pay to get a bar in your hand, is already trading at a $300 premium. This decoupling is the clearest sign that the system is breaking. Strategy: the 3 pillars of 2026 survival. To conclude, the global debt death spiral is not a disaster to be feared. It is a process to be understood. It is a massive transfer of wealth from those who hold promises, bonds, cash, bank deposits, to those who hold provisions, energy, food, metals. To survive the remainder of 2026, I am adhering to 3 strict pillars. 0 sovereign credit. I am holding 0 long-term government bonds. Being a creditor to a bankrupt superpower is not an investment, it is a donation. The $1.3 trillion interest bill proves the math is terminal. Tangible production, the minor play. I am heavily overweight in companies that produce energy and metals. In a currency crisis, the world starts caring about price to atoms. I am buying the miners at these corrected prices because their margins at $4,714 gold are still astronomical. Self-custody and decentralization. Whether it is Bitcoin, which is acting as the digital collateral layer, or physical gold and silver, you must remove the counterparty risk. The mathematics are final. Do not let the red on your screen discourage you. The mathematics of the 2026 debt spiral are final. The interest payments cannot be stopped. The Fed's insolvency cannot be hidden forever. The deferred asset scam is running out of time. Gold at $4,714 and silver at $71.50 are gifts. They are the market's way of giving you one last chance to exit the burning building of fiat currency before the doors are locked. The spiral is accelerating. Ensure your family is positioned on the right side of history. I'll see you in the next update. Stay analytical. Stay disciplined.